If you are a dividend investor, you want to create passive income from dividends, it's important to know what dividend yield you should look for. Because as I said earlier, it might seem attractive to look for stocks with the highest dividend yield, but those are the riskiest investments. A higher dividend yield means higher risk. Because a dividend yield is one metric that gives us clue about the valuation of the company, how other investors value the stock. But what is too high and what dividend yield is too low? When I'm looking for dividend paying stocks, I always compare their dividend yield to the market average, the S&P 500. Dividend yield should be at least 1.5 times the market average, and it can be only 3 times as high at most. So, for example, if the dividend yield of the S&P 500 is 2%, then I mostly look for stocks with a dividend yield from 3% to 6%. But why are these numbers? Well, there are 3 reasons for the lower limit. First of all, a 2% dividend yield is not enough for me, because this is the inflation rate in the United States, and I invest in only US companies. So if the inflation rate is 2% and I get a 2% dividend yield, then I don't really make money. Of course, we also have a capital gain on stocks, but I would like to have a real income from dividends too. Secondly, I like to buy stocks that are undervalued, because this minimizes my risk and maximizes my returns. And the dividend yield gives us a clue about the valuation of the company. So if the company has the same dividend yield as the market average, then it's probably not undervalued. And here's the third reason why the dividend yield has to be higher than the market average. Let's say the S&P 500 has a dividend yield of 3%. And let's say I'm okay with the 3% dividend yield. Then why would I bother picking and analyzing stock when I could just blindly buy the S&P 500 with a 3% dividend yield? Picking individual stocks involves higher risk and a lot of research and work. So this is another reason why it doesn't make sense to buy stocks with the same dividend yield or even lower than the S&P 500. Just to be clear, it doesn't mean that I never buy stocks lower than 3% or higher than 6%. There are rare exceptions when I do buy stocks lower than 3% or higher than 6%. But the point is that I mostly look for stocks between these numbers. And the average dividend yield in my portfolio is about 4%. And by the way, 4% is the dividend yield of the portfolio of an average dividend investor. Now, I already talked about why you shouldn't look for stocks with a too high dividend yield. They are the riskiest investments. But why is the 3 times multiple? Actually, I know dividend investors who say that they look for a dividend yield up to 5 times of the S&P 500. But in my experience, most of the time, these stocks are very risky investments. So how do you find the dividend yield of the S&P 500? The easiest way is to go to Google and search VOO dividend. The ticker symbol VOO is an S&P 500 ETF. Now on the website of Vanguard, I see that the quarterly dividend is $1.2625. This is a quarterly dividend, so I have to multiply it by 4, which is a $5.05 dividend a year. The price of VOO is $378, so the dividend yield of the S&P 500 is 1.33%. If I multiply this by 1.5, I get a 2% dividend yield for the lower limit, and if I multiply it by 3, I get a 4% dividend yield for the upper limit. So today, the stock market average is so high that any stock above a 4% dividend yield is too risky for me to buy. But as I said before, there are exceptions sometimes. For example, I bought AT&T this month with a 7% dividend yield. But we need to be aware that these stocks involve more risk. And as I said many times before, the dividend yield is only one metric. So please don't just go and buy any stocks with a dividend yield between 3 and 6%. A dividend paying stock is not a bond. So we need to check many other metrics before we invest in a stock.